Okay, everybody, here's lecture module 8c. I'm going to deal now with security evaluation regarding common stock. This is going to be a little bit of a long video because I don't want to break it up, first off, and then secondly, because of some technology issues this week, I've gotten myself behind a little bit, so I'm hoping that I can pull off most of this with enough of a straightforward presentation that you can pick up the high points. This is a hard part of the course, so I want you to pay close attention. I'm going to be throwing a bunch of different equations into this into the series of steps that we've got here. Okay, and so let's deal with security evaluation. We're talking about how we value common stock. Okay. So our task here is to explore the valuation of a share of common stock like Google or Apple, right? What are the factors that give rise to the closing price that we might observe? So if you buy a stock, right? If you buy a stock, how long are you going to hold it for, right? So the holding of stock, let's set that in place. We're going to say that you're going to hold till infinity, right? Now that's unlikely, of course, but what we're trying to get across is that you could hold it forever. You could, of course, have multi-generational transfer of the stock. So we could say that you or your progeny are holding the stock. You might decide to sell it, of course, but why else would we desire to hold it? Let's say you're an investor and you decide that you want a 1-year holding period for your time horizon. And this is giving us the ability to start off with a sort of simple case. And let's say that you think you can sell your share of stock in that one year. Let's say the sale will be at a price P1, okay, equal to $100, and that you would have just received an annual dividend. Okay, your annual dividend would just have been, let's say that let's say that you were going to get a $3 dividend. Okay, so you have $100 that you'll sell at a year from now, and you got a $3 dividend. Suppose that the required rate of return R is 15%. All right, for the stock, and we'll come again a little later in the course, and we'll examine how we will construct this value for the required return, but we're holding off for now so we can pay attention to the more important sort of mechanics here of stock pricing. So the question would be, so right now you would want to buy this stock, right? What in time period T0, right? T equals 0. What would you be willing to pay? And what would you pay for this stock? Okay. So that's just saying, right, the present value is equal to the dividend you get in time period 1. Let's discount that by 1 plus R. That's just one holding period. And, right, we'll get a price, P1, at the end of this time. So I'll discount that at 1 plus R to the first. This is equation 1. Okay. Let's plug in some numbers and just see mechanically what we do. I got $3. I'll discount that by 1.15 to the first power. Then I'm going to get $100. Discount that by 1.15 to the first power. Right, this is equal to, for our example, 89.56. Okay, and the capital gain on your investment when you sell would be the difference, right, between $100, the sale price, and your current purchase price of $89.56. Right, so that's 10.44 in cap gain, right? So that's an element to watch for, because note, let's give ourselves a little bit of extra info here. The required rate of return R, right? Say you got a $3 dividend. You invested $89.56, right? And then at the end of the holding period, you sell for 100, and you paid $89.56. There's your capital gain portion there. Let's divide that by $89.56. The first part of this equation is 0.0335. The second part is 0.1165. That's 0.15. Right? So that's your total return. The total return in this case, right, you see it. It equals the dividend yield and the capital gain yield. So you see that a total return has these two components. If there are no taxes in our world, we'll just assume that for now, then you don't really care about the mix of the components. The dividend yield and the capital gain yield would come, and you don't care. You're just getting a return. Right? So why would anyone buy the stock from you in time period T1 for 100? Right? Why would that happen? So let's continue this example a little bit. You're trying to sell this stock, right, in time 1. Time equals time period 1, right? Now, clean this up a tiny bit. Time period T equal 1, right? Why would someone buy it? I mean, that's what you're hoping will happen. So somebody would be willing to pay some money. Let's assume the investor that you sell to also has a 1-year time horizon, right? So she plans to buy it in T1. Sell in time period T2, we'll call it. Okay. And so now you can calculate the price that they would be willing to pay in P1. Right? It's the dividend they expect to get across the second time period. Right? And for them, they'll discount this just one period because they're only got 1 year holding, right? And then, right, they might sell too, of course, right? So they have a 1 year holding period. They sell it at price P2. They bought it at price P1, right? So they have to discount that by 1 plus R raised to the first power. Now this is equation 2. All right. So you would want to search for certain combinations of the dividend in time period 2 and the price that you would sell for in time period 2. This would have to justify the $100 price. So let's assume R continues to be 15%. So there's really an infinite number of combinations of this dividend price set of combinations, right? So it has a present value of 100, right? That's how much they're buying this for. Let's assume that this individual forecasts the dividend dividend in TIV2. Let's say they think it's going to be $3.30. And then further, let's suppose that they believe that someone will buy from them for $111.70. So you could say, well, let's apply this information to the equation. So $3.30 for my dividend divided by 1.15 to the first, right? And then we get 111.70. Again, that's right. That's got a little bit of a capital gain involved. So I'll get 1.15 raised to the 1. Right. So that's equal to $100. Now, what we're going to do is a little bit of math here. So we got to pay attention to something that's about to happen. I'll tell you what I'm going to do. I'm going to plug equation 2 into equation 1. See, because in the equation I've got a value P1 that's sitting in equation 1, and equation 2 just helped me calculate P1, right? So let's just look at what this math would generate. So the present value, right, P0. So that's dividend 1 divided by 1 plus r raised to the first power, okay? Plus, and now I have P2 sitting here, so I've got to take the second equation. Now the second equation is dividend 2, okay, over 1 plus r to the first, right? And plus, right, P2 over 1 plus r to the first. So that is the splice, say, that's equation 2 now plugged into the first equation, and that bracketed thing we've got to discount by 1 plus r to the first. And we can therefore kind of just sort of arrange our terms a little bit. And what you'll notice is I'm just going to kind of nudge this equation a bit, follow what I do. So P0 is equal to the dividend in period 1, right, over 1 plus r to the first, okay, plus dividend 2, right, divided by, and see, I have 1 plus r raised to the first power, right? But it has a denominator of 1 plus r to the first, see? So when I pull that little denominator out of this, what I get is it's really 1 plus r squared. And then I have that, right, and then I have the sale price, P2, over 1 plus r, right? And again, it has this denominator right here sitting underneath, right? See, it's divided by, right? So that again, I can simplify, right? So it's 1 plus r squared. Okay? This is equation 3. Now, continue. You could say, well, if let's say if we develop equation, let's call it equation 4. Really, it's just sort of a parallel way of thinking from the lesson we've drawn out so far, right? So equation 4 is, right, so P2, that's equal to the dividend one gets in time period 3 divided by 1 plus r to the first, okay, plus, okay, somebody is going to resell it, price P3, 1 plus r to the first. So there's equation 4, where I've pushed things out, one more time period. So if we plug, right, equation, let's kind of call this equation 4, right, into equation 3, right, see, I've got this value of P2. Let's highlight that so you see what I'm doing. I'll make it pink. See, P2 has been defined. And look where P2 sits in equation 3. Right, P2 is sitting right there. So all I'm doing is this little bit of a substitution. And I get, right then, P0. Okay, that equals dividend in time period 1 over 1 plus r to the first. Okay, plus a dividend you get in time period 2 over 1 plus r to the second, right? Plus, and we can go out, since we've got a third period to think of, a third dividend is paid. That's 1 plus r to the third. Then the sale happens at the end of time period 3, so it's now 1 plus r to the third. You can proceed by calculating P3 again in terms of dividend 4 and price 4 and so on. You keep doing this over and over and over again, and you get the sort of general result. So the general equation that you can kind of conclude arises here. Price and time period 0 is dividend 1 over 1 plus r to the first plus dividend 2 over 1 plus r to the second, right? Plus dividend 3 over 1 plus r to the third. And there's this pattern that's been developed, right? You can see it. So it goes all the way out to some holding period. Sorry. That's supposed to be a D. Don't know why. Bad writing on my part. Sorry. So go out to dividend held to time period. Let's call it N. Right? Discounted to the 1 plus r raised to the N. And then then you add in, right, the final price. So you sell the stock in time period N. And then so you got to discount that amount of cash flow and 1 plus r raised to the N. So now you see, and you can you can collapse this. So we should say, or really what we mean here, or well, so P0 is the sum, and you're running from time period, right, 1 to N. So it's the sum of dividends received in certain time periods, T, and discounted to the 1 plus r raised to the T. And then you sell the stock in time period Pn, discounted by 1 plus r to the N. Now, as N approaches the value of infinity, and remember, stock has no maturity. So as that happens, you could say that P sub N over 1 plus r to the N, right, that is approaching the value 0. Right, so therefore, something very interesting occurs. We can just say that the current price is equal to, all right, we'll run from t equals 1 to infinity. So I remember right before I said let n approach infinity, right? So that's dividends received in time period t over 1 plus r raised to the t. And this is equation 5. All right, this is the basic common stock valuation equation. It's telling you that the current price is a function of the future dividends to the current shareholders. And it's only the dividends to the stockholders, right, that matters from time period T0 basically onwards into the future. That's what is determining the price. The model says something about what the value of the common stock is. Right? It's the present value of the future cash flows discounted at the required rate of return. Now, actually, a firm sometimes can do a repo, right? So you might get paid dividends, right? You might see a repurchase, right? So a stock repurchase is another way to give the stockholders back some money. That's a special case of a dividend. Another way that investors can get cash out of firms is through merger and acquisition activity. So that's a form of dividend. A firm might also liquidate, and as a result of liquidating, it will do what we'll call a liquidation distribution to the shareholders. Again, that's just a special case of a dividend. So some dividends are a source of, right? So dividends, regardless of their source, right? They're a source of cash to the holder of the share of common stock. Therefore, right, what is going on, right? Dividends, right? Simpler than it looks really at first, but now it makes sense, right? The dividends are the source of cash to the holder of the share of common stock. So dividends are, right, the source of value. If it that's got to be adjusted a little bit. So let's just do a small adjustment. Suppose the dividends could grow at a constant rate. Let's say they grow at a constant rate. This is what we could say is just the same thing as, right? Remember, it's a growing perpetuity. So the situation for that we can recall from previous lecture. So I'm just kind of redefining the cash flow value in its generic terminology, just to turn that into my dividend, right? So it's whatever my dividend would be in time period 1 divided by R, right, the required rate of return, minus G, the growth rate. And that's equation 6. Okay? So equation 6. Let's do some examples. Let's do case 1. Let's say that the current price is P0 on the stock is an unknown, right? And let's say that it just paid a dividend. Let's say it paid a dividend of $3. And let's say the market is requiring a rate of return on this kind of asset at 15%. Let's suppose that we think the dividend would grow, right, at 10% growth rate, and let's assume that might happen forever, right? So the price we would see that should generate here in the market, take $3, the dividend, okay, let it grow, 1.10, let it grow 1 time period, right? And then, right, we see its growth in that time period take place. So at the end of that time period, you get a 10% addition, 10% higher amount of a dividend, right? Divide that by 0.15 minus 0.10. Okay, and if I've got my math right, you can check me. Right, that's a stock price running $66. Okay, and you see the first dividend was 3. The next dividend is what was interesting there. That's the expected value of $3.30, right? So case 2, let's do that one. Here, what if the dividends are not expected to grow? Okay, so now you have the perpetuity situation. So, sorry. You know what? Something needs to be adjusted there. There we go. So in our perpetuity situation, the current price is the dividend that would happen in time period 0 divided by R. So we plug our numbers in, right? So P0, I have a $3 dividend, right? And just divide by 0.15. So that would generate a price, right, of $20. See how far lower the price is for this stock, as opposed to the stock that had a positive growth rate in its dividends. Right? Think of case 3 next. What if the dividends are expected to decrease at a constant rate? Let's say they would decrease by 4%. You can still use the equation, but now see the growth rate is equal to, G here is equal to minus 4%. Okay, so price now would run, so you got $3. And so you got to go 1 plus minus 0.04. Okay, take that. And now you would go divide that by 0.15. Right, minus negative 0.04. Okay, so this would be 288 divided by 0.19. And you get 15. That equals to $15.16. That's far less than the price when it was even at a 0 growth rate, right? So important point here, right? A dividend growth rate could be negative. It could also be positive. It could be flat as well. Now, come back to equation 5, the key equation in the entire dividend as value idea. Remember, it's the sum of the dividend flows, which are cash flows, from time period 1 to infinity. Whatever that was in the first time period, dividend 1 divided by 1 plus r, right, to the t. So this was equation 5. This is the basic common stock valuation model once more, okay? Price, therefore, is the function of the future dividends to the current shareholders. Notice it's only the dividends that accrue to the shareholders that matters, okay? Dividends are the source of cash for those who hold the common stock. So dividends are the source of the value. But what about the capital gains? What happened? I asked the question because it looks like we just played kind of what you could call a mathematical trick, remember? Pushing the holding period out to infinity seems somewhat unrealistic, right? I mean, who plans to hold stock until infinity? Right? Have we left out the capital gains? Right? What if I plan to sell the shares in the future and then realize a capital gain in addition to the dividends? I mean, why do I not have the capital gains showing up in this equation? So there is a quick answer to this, somewhat quick. And then there's a little bit of a longer answer we'll get to. So I just have to justify this quick answer, I think. So the expected capital gains of the stock are actually not left out of equation 5. Okay, expected capital gains are caused by expected dividend growth. That should make sense, right? So, dividend growth is included in equation 5. So, capital gains are then clearly included in equation 5. So, if you try to remember how we actually arrived at equation 5, you see that foundationally, capital gains are actually part of the whole deal. Now, can we prove that? Can we show how that might work? Imagine that you have two stocks. So this is an example to watch carefully. So you have stock A. Let's say it has expected dividend, time period 1, of $10. And let's say it's got a 0 growth rate forever. And then I have stock B. It has an expected dividend at time period 1, let's say of $10. And this one has a growth rate of 10% forever. Now both A and B, let's say, have a required return of 15%. So they have sort of similar risk profiles. So notice, just sort of, set up what the future expected dividends look like. So let's just do stock A and B. on a little table. And go to time period 1. We'll go just to 5 time periods. And we know in each time period there'll be a dividend. Okay, so just set up what the dividend looks like in each of these. And of course, stock A has a price of 10, or sorry, a dividend of 10, right, throughout the time periods. Stock B started at 10, and then it goes to 11, and then to 12.10, then to 13.31, and then to 14.64. You could, of course, continue this. Now, both have a constant growth rate. So you can just use the growing perpetuity equation for these. So the perpetuity version of, remember, the stock pricing. I should mention, by the way, it has a special name. This is called the Gordon model. It was named after Myron Gordon at the University of Toronto. People think he was probably the first one to derive the equation in the modern financial literature. But J.B. Williams had a dissertation at Harvard in the 30s that did actually work through the mathematics of this. But here's the equation. Remember, price is going to be dividends received at 0.1, right, divided by R minus G. Remember, that's equation 6. So, using that equation, you can actually calculate the price of A and B at each point in time. So, I did this in a spreadsheet, but I'll just kind of copy it because it's not very large. And so what we're doing now is going to price P0, P1, 2, 3, 4, and 5. So I can do this and say, well, here's what the price would look like at each of these points in time throughout the future, right? Stock A is actually going to be 66, 67. And remember, there's no growth in the dividend, right? So in each period in which evaluation takes place, people look and they say, oh, I see a perpetuitous, right, dividend of that amount of $10. In stock B's case, right, it's actually going to be worth 200 at first. Then it goes to 220, then to 242, to 266.20, then to 292.82, and then to 322.10. So you see, stock A's capital gain growth per year is 0. It's because its dividend growth rate is 0. Stock B has a capital gain growth per year equal to 10%, exactly the dividend growth rate per year. So the bottom line of the example, right, the capital gains growth is caused by the dividend growth. See, so equation 5 includes the dividend growth by including the specific dividends for each year out to infinity. And since dividend growth is included, the capital gains growth is directly implied, right? So it's sort of like a folding into the dividend stream, okay? And equation 5 is the general model, right? Any dividend growth pattern could be accommodated into that equation. You might have rising dividends or falling or level. You might have particular time periods in the future that there's a lot of irregularity. You might have no dividends sometimes. And equation 6 is actually kind of a simplified equation that only works under certain careful conditions, right? Carefully required conditions. So you can rearrange equation 6 for some insight. Solving it for R. R is equal to dividend in time period 1, right, divided by P0. Okay. Plus G, the growth rate. For stock A, at time period 0, we would say you had a dividend of $10, right, divided by 66.67, right, plus 0%. You get 15% out of that, right? Look at stock B, also in time period 0, and you have a value of $10 in the first period. So that's the dividend in time period 1. Divided by 200, plus 10%, right? Plus 10%. Or 0.1, you could call it, right? So this is actually 0.05 plus 0.10. So that one equals 15%. So the current dividend yield of 5% and the dividend plus the capital gain growth rate in place, right? That's the extra 10%. And we can look at something later. It's called equation 7. This one. We can look at something a little later that allows us to estimate required returns. Okay, we'll come back. In the case of when there's common stock, we'll be able to get a sense of what required return there would be. Now, the tough part of equation 6 and 7 is actually coming up with the estimate of G, the growth rate. You have to forecast that. So just a brief comment there, right? It's difficult. That's the tough part of this section. And yeah, you got 4 methods. That can be used, that often are used, to estimate G, the growth rate. So one thing to do is to look at the past. Basically, you look at the past growth rate of dividends. People think, oh, let's project that into the future. Or you could use analysis work, right? You have, in the industry, you have forecasts being made by analysts all the time. You might have the S&P analysis group. It's the earnings forecaster. You might also use the sustainable growth rate. That's possible. Now that's SGR, we'll call it sustainable growth rate. That's the return on equity, right? The return on equity times 1 minus the payout rate. And of course, you could just use your own personal research, your own private information. All right, you could call that, say, personal judgment. I recommend the 4th method. If you don't have some data to process and try to put forward a personal judgment, then the 2nd method is probably valuable for people, right? Past dividend growth is not a good indicator of future dividend growth. And the SGR equation is somewhat unstable over time. So highlighting what you should use, right? Probably expert forecasts and personal judgments. Equations 6 and 7 are often misapplied. Where is the equation appropriate? Say, equation 6 and 7, remember, are sort of intertwined. All right, suppose you have a mature and steady growth company like a public utility firm. This model would not be very appropriate for such a situation. Suppose you have a fast-growing, say, young company, and it's going to potentially have, a pretty good growth rate in dividends initially, but it won't be able to, of course, maintain this. Say, suppose the company currently pays no dividends. yet you're looking at a high growth company that has no dividends. That implies that the rate of required return R is equal to G. And in that case, G is very, very hard to estimate and unstable. But we arrived at equation 7, assuming that the firm's dividends would grow at a constant rate. Right? So to use a formula that assumes a constant growth rate forever is actually not a good idea. And that's because of stock price valuation being rooted in the predictions about the dividends. And we can get some evidence by observing what's going on in stock prices. And we see a lot of volatility in the prices. Suppose there's a stock and it seems to be a good candidate for us to use the Gordon model. So the current price on the stock is dividend in year 1 that we expect divided by R minus G. What assumptions would we make in this? Right, remember, we're saying, well, G is a constant forever. And that we also must assume, right, that R, the required rate of return, is greater than G. The reason for that is the calculation is constrained because we'll get an undefined equation, right? Or we'll have a stock price that's negative. And of course, that's not acceptable. Sorry, the undefined equation is occurring when R, right, is less than G. Now, we know R is the market required rate of return. The market rate of return is actually required on the basis of, we'll call it R sub F, okay, plus, let's call it theta. And R sub F is the risk-free rate. There's some asset out there we could invest in, such as a T-bill. And there's a rate of return on that asset. And the theta. Well, that is the risk premium. Which is it's associated with the stock's level of risk. So different levels of risk imply different risk premiums. Example, let's say that the T-bill's running at 4.5%. And let's say that you're looking at a stock that has a risk premium of, let's say 8.5%. Now where that comes from, we'll talk about a little later. So, right, the R that's appropriate on this stock would be 13%, which is 4.5 plus 8.5, right? There's going to be a more discussion, actually I should say a lot more discussion on the risk premium. You can also decompose the risk-free rate, R sub F. Into the expected inflation rate, call it E sub I. So this is expected inflation. Okay. Plus a real rate of return. Now, that's an approximation. This is just what the market requires over and above any expected inflation rate. See, if the risk-free rate were equal to the expected inflation rate, investors would get a real return of 0, right? Now, T-bills historically have earned about 0.5% more than the actual inflation rate. So a pretty good, reasonable forecast, right, for real rates. Probably around 0.5%. So that's a little background, but then we wonder, hey, why then? Why do prices of the stock out there in day-to-day trading, why do stock prices change? So remember the Gordon model. Let's go back to P0 equals dividend, time period 1, over the required rate of return R minus G, the growth rate. So, right, the situation of the firm is what's at stake here, or maybe of the broad economy. Let's just give examples of things that could be changing in our world that would make people revalue or adjust their values in terms of they think that the stock should be priced at P0. Well, say, what if the expected inflation, EI, right, goes up or down? Remember, expected inflation is embedded inside the R, the required rate of return. Say, what happens if the expected growth rate of the firm goes up or down? Some kind of information might come our way that says, hey, the growth rate in the firm's dividends is going to change. Maybe the market revises its forecast, right? So what if the forecast of the value of the dividends in time period 1, what if that goes up or down? What if the market risk of the firm goes up or down? So you can understand why stock prices will change and change frequently and often change dramatically. Now, a couple lessons of note. Consider stock prices and what we often see in the financial literature, price-earnings ratios. PE ratios take the current share price, right, divided by typically the trailing annual earnings per share. Okay. Sometimes there's maybe a forecast. Now, PE ratios are often understood kind of badly. That's the main goal here, is for you to take this lesson away, that the PE ratio, what's it all about? It's misunderstood. Sometimes it's said to be a tool, a trading rule, how you pick stocks, whether you invest in a high or a low PE kind of stock, and then, okay, get rich. But think about what the price-earnings ratio is, right? The numerator is the stock, which is valued as the discounted stream of the future dividends. Right? P is a market-determined number. Right? It's coming from the discounted stream of the future dividends. The denominator is earnings per share. Now, earnings per share, E, is earnings per share, right? So that's after depreciation, right? So that's income after depreciation after interest, right? It's after taxes. Also, any preferred dividends that may have been paid. The earnings per share could be paid as a dividend, or they could be retained. So what's going on, right? Yeah, earnings per share, right? Earnings per share is a historically determined accounting number. So you're dividing a market number, a market-determined number, by a number that's determined by historical accounting data. What do you get? Is there anything of value to this? Is the PE ratio somehow related to P sub 0? Right? Well, we know from our valuation lesson so far, the stock price is going to be affected, right, if the firm invests in a project that generates a rate of return that's different from the market rate. Maybe we're lucky and it's doing better than the value of R that we thought would be in place. Let R star be a project's rate of return. So suppose we say, well, what if R star, let's say that it's greater than R, which was the required rate, right? Well, P0 should increase. Project, right, remember, it has a positive net present value. What if R star what if R star is less than R? P0 should fall. If R star equals the required rate of return, right, there's no change in P0. Say you have a firm with a large number of positive net present value projects. They have them in place. They have new projects coming online that are positive NPV. So these are firms that would be expected to have pretty high current stock prices, right, relative to their current earnings. So for growth firms with lots of positive NPV projects, you're going to see them with high price earnings ratios. And that's a relationship we actually do see in the market data. So we could conclude, right, high growth firms, right, they have high, or they have high PE ratios, typically, right? And firms that have low growth rates, it's the opposite situation. That's right, they tend to have, right, low PE ratios. So, right, the PE ratio is an indicator of really no use. I mean, it would be great if life were easy and we could use the PE ratio to grow rich, right? I mean, you say, oh, look, high growth rate firms have high PEs, but that is a regularity that you can't really use to get rich, okay? It's not like you're going to be able to find some underpriced growth stock. See, the PE ratio is therefore not really useful to pick stocks. You can't say, oh, PE ratio is an indicator of some kind of future rapid performance of a firm, and right, you're saying, oh, that should justify a firm having common stock with a high stock price. The real thing that is that if you pay more for, let's say, stock B, it's because you think you're going to get larger future dividends, and that justifies the higher stock price. You pay less for stock A because you think the smaller future dividends justify a lower stock price. And that is the basic valuation model put in its most simple terms. In either case, the return on each stock is 15%. You really don't care which stock you own. If you ignore tax issues, the answer really is no. Right? Both stocks are generating the same rate of return based upon the price you're willing to pay and the return that you demanded. If they have basically equivalent risk, then you're indifferent between these two stocks. See, so the PE ratio cannot be used to pick stocks. It doesn't perform as a useful device. See, all stocks with the same risk are going to be priced to earn the same expected return. Market prices are indicating the required rates of return, right? PEs don't use them. Right? Don't rely on PEs. It's not that easy. So that's the lecture on common stock valuation finally put into the mix for you guys. Let's put it up on Blackboard and I'll be able to start my lectures for the following week. What we're going to work on next primarily is the efficient market hypothesis. So let's stop this recording and get ourselves